So every quarter, the largest publicly traded apartment companies in America get on earning calls with Wall Street analysts and say exactly what they're seeing in the market. They're talking about the real data, the real occupancy numbers, the real lease pricing trends, all submarket by submarket. At the end of the day, they have to, right? These are publicly traded companies. And so for private investors like us, these calls are actually a gold mine of real time intelligence that many investors never read or see. So Q2 2026 earnings season just wrapped up for the major apartment REITs. And the headline from Multifamily Dive is this, all about Sunbelt momentum. So MAA, one of the largest Sunbelt focused apartment REITs in the country, is calling for what could be an unusually strong Q3, driven by the highest inbound migration they've seen recorded to their properties in a single quarter. Now, Camden, another large REIT, actually just sold its entire California portfolio and redeployed 1.6 billion into Sun Belt markets. UDR also raised guidance, right? So the coast-focused REITs are also doing well, but the story that matters most for how we invest is what's happening in the markets we're active in and watching closely: Atlanta, Tampa, and Charleston. Also keeping our eye on the Texas markets as well. So today I'm going to walk you through these Q2 REIT earnings data market by market, pulling out what actually matters for private investors in Class B workforce housing, and being honest where the numbers look great and where there's still work to do. So I'm John Makarewicz, co-founder and president of Ferris Capital Partners. Let's get into it. So why are REITs earnings calls some of the best market intelligence that you're perhaps not reading? Well, at the end of the day, public apartment REITs, so big ones like I've already mentioned, MAA, Camden, Avalon Bay, Equity Residential, Essex, et cetera, collectively own hundreds of thousands of units across US markets. And their earnings calls are real-time sub-market level operating reports. So they're reporting on occupancy rates, effective rent changes, blended lease rates, so that's new leases and renewal combined, concession levels, turnover rates, expense trends, and forward guidance, all market by market every 90 days. So this is something we watch closely, right? So basically, the REITs are often in adjacent or overlapping submarkets, and their data is the most granular public intelligence available on market conditions. So one important caveat here is REITs do typically own Class A or higher quality Class B assets. So the rent figures and occupancy numbers reflect that. Now, Class B workforce housing often behaves a little bit differently, particularly on the downside in a supply cycle and on the upside in recovery. So read these trends directionally, not as exact comps, right? So what does the Q2 earnings season mean? So all six major apartment REITs reported between late July and August 10th of this year. Of course, for Q2, we're looking at April, May, and June operating data. And forwarding guidance is looking into Q3, right? So that's almost equally as important. What are the CEOs saying about July and August trend in the most current real-time read on the market, where it's headed, right? So some of the things that really jumped out. So we're really going to focus on MAA here. They are one of the largest Sunbelt multifamily REITs in the country. So their revenue was actually flat year over year, but same-store revenue came in slightly a little bit below expectations. Now, bottom line is year-over-year declines across the board, but the rate of decline is narrowing. So it's not a trough picture. It's not a worsening one, right? So most important story, forward demand signals, right? What are they seeing? So inbound migration to properties owned by MAA in Q2 was the single strongest quarter increase MAA has recorded since it began tracking this metric. So that's huge. Apartment absorption across MAA's footprint substantially exceeded new delivery during Q2. So demand is outpacing new supply coming to market. And lead volume and property visit activities are up. We're actually seeing that as well. We're actually starting to see our cost per lead come down and more leads coming in for our properties. So MAA expects Q3 blended lease pricing to improve from Q2, kind of breaking a seasonal pattern where you often see Q2 being one of the strongest. So this is a directional break from trend that definitely deserves attention. So, CEO Brad Hill of MAA had this to say: while recovery in new resident lease rates is showing improvement, the pace is still slower than we would like. So prospects in high supply markets are shopping longer and deciding later, which basically is a signal of more cautious consumer behavior, not absent demand. So that's something we're seeing, right? What we've really focused on with our properties is speed to lead and aggressive follow-up, because we are seeing apartment shoppers shopping a little bit longer and looking at more options before making a decision. So one other factor that they're focused on, right, is how do we keep the resident turnover low, right? So this is something they're seeing, right? They're seeing fewer people move at renewal. And so that is something that we are heavily focused on as well. So providing a really exceptional resident experience, making sure work orders are processed quickly. We're following up after work orders and having just random touches throughout the year with all of our residents where we're just checking in to see how things are going. Little things like that. I mean, let me go back a little bit. Work orders is not a little thing. We got to get those right. We got to get those done quickly. But just these little follow up touch points after a work order or just a random check in go so far in terms of resident retention. We're also starting to see, and we're feeling this too, but MAA reported this as well, some more favorable insurance and property tax trends. So post pandemic, a lot of municipalities froze taxes and the assessments, and now they did a big round to catch up. And so a lot of people had shock with new tax rates coming in, but we're starting to see that moderate a little bit. So let's shift gears a little bit to Camden. So Camden actually is interesting to me because they just sold all of their California real estate. They cleared up $1.6 billion in capital and immediately moved all of that into the Sun Belt. So their rationale, basically, Sunbelt markets have stronger population growth, employment growth, domestic in-migration, household formation, and long-term multifamily demand. Over the last 30 years, Sunbelt cities have led the U.S. in every one of those metrics, and the trend looks to continue. So when they were looking at their California portfolio, basically, they were just lagging behind other markets that they were investing in. So basically, they got out of California and have now pushed everything into the Sun Belt. Basically, the CEO of Camden had this to say: "We believe these trends will continue to make the Sun Belt an attractive place in which Camden residents can live, work, and play." So, where did they redeploy this capital? So, basically, they invested in markets that we like to invest in. So, Alpharetta, Georgia, where I actually live, they picked up some properties. Orlando and Tampa, in Florida, Franklin, Tennessee, which is a fast-growing, incredible suburb right outside of Nashville. Roanoke, Virginia, Texas, Gilbert, Arizona, and Charlotte, North Carolina. So they have actually bought some new land parcels as well in Tampa and Morrisville, North Carolina, where they're going to be developing some new buildings. So, when I see a large REIT like that completely divesting out of California to move over to the Sun Belt, that's a great signal. So many of the other REITs reported as well, right, that kind of support this Sun Belt story. So we're seeing, kind of a challenge right now. And we've talked about this on podcasts. If you're an investor with us, you've seen it in our investor updates. But over the past 6 to 9 months, we have started to see an increase in things like delinquency. In other words, when residents are unable to pay their rent. And so it is definitely a big pain point. A lot of new buildings are offering 1-2 months free rent, right? And so even though we're Class B and kind of play in a different space, that is impacting us a little bit. So some of our properties, we had to have had to give some concessions just to keep leasing momentum going. So that's where that resident experience I touched on a little bit earlier, and I barely scratched the surface of what we do around that is so critical, because if you give a concession to get the resident in, we got to make sure we retain them and renew them and get those rates, right? Because basically with the concession, you're getting market rate, but the concession offsets that income. Sometimes concessions are given like a full 3-month rent right at the top, or it's spread out across the year or the lease term. And so at the end of the day, your economic occupancy is lower, right? And so it's important that you have a really great resident experience so that when the time to renew comes in, you have to remember that concession's now burned off. So their rental rate will go up to market plus whatever that new renewal rate is. So it's all about that resident experience. So, once again, we'll touch on a few of these, but, a couple big REITs are merging. They're getting out of New York City and San Francisco, focusing more on the Sun Belt. And so let's talk a little bit market by market, right? So Atlanta, Georgia, it's a recovering market. And because when I say recovering, what I mean is Atlanta saw a lot of new supply, hence concessions, hence things like that impacted property owners. Also, we have to mention, right, rising interest rates and rising materials costs. So what this all boils down to is it's all about controlling your expenses whenever you're in a market where there's headwinds sort of impacting rents, right? So doing as many repairs in-house as possible. So actually at Ferris Capital Partners over the last few months, we've actually made quite a few personnel changes at our property. And we've been bringing in maintenance supervisors that are really sort of like certified HVAC technicians that can do that work themselves, saving thousands and thousands of dollars when an AC goes out. In fact, we've restructured their bonuses to be reflective of basically a few things. Number one, client experience, right? So giving us 5 stars after a work order is complete is a factor of their bonus. So the more 5 stars they get, the bigger their bonus. We want that really work order not only be completed, but done in such a way where the resident really feels good and appreciated and excited that it was done so quickly. But one of the other factors, and the most important one, and I'll touch on a couple of them, but the speed, right? We want these work orders done within 24 hours unless a part needs to be ordered. But the biggest one is we basically incentivize those maintenance supervisors to do repair work in house versus going out to a third party vendor. That is one of the single best areas we can control expenses by having the right team in place that can do the work in house without having to go out to a third party vendor who can sometimes increase the cost by 3 or 4x doing it in house. Tampa, Florida, there is some supply pressure, but it is stabilizing. We own an asset there. Charleston, South Carolina is actually leading. Not seeing a whole lot of challenges there. Now, what we are seeing is what I mentioned earlier, which is delinquency, right? People who are in our apartments perhaps have lost their job or lost some hours of work. And so it is a real thing that we're struggling and working through. But I say struggling, we have a plan. We move quickly. We process the evictions. We're knocking on doors and inviting people to leave and helping them find an apartment that's maybe more affordable. So it's all about that resident experience. So, other markets like Nashville, fundamentals are still strong, lagging a little bit. Austin, Texas, recovering, but not really a market we're interested in. So much new supply there, right? So let's talk a little bit more specifically about Atlanta. So Atlanta is one of MAA's largest markets, and both are outperforming the portfolio average on blended lease pricing in Q2. So that's a meaningful positive signal. Camden reported that a majority of its Atlanta communities had positive signed new leases in July. So they're seeing rents start to increase. Atlanta is one of our most active current markets. We own assets here. We're all about the market. Demand is real. Absorption is catching up to supply, and renewals are holding. Charleston, once again, outperforming. So markets like Charleston explicitly was called out on some of these REIT calls as a market where concessions have declined. Charleston is also the tightest supply environment amongst our markets at Ferris Capital Partners. There's limited developable land. In fact, I encourage you to just go on Google Maps and type in Charleston, South Carolina. And when you zoom in, you'll see there's sort of these paths of progress that come out from the city. Well, the reason that is all that land in between and on the outsides is like marshland. It's undevelopable. So it's kind of a market where there's limited land to help grow and build new buildings, right? So at the end of the day, that's a good thing for us. Also is leading in terms of in-migration from the Northeast and Midwest. In fact, I just talked to an apartment owner operator out of New York City who's moving his entire office to Charleston, South Carolina. It's a great city, a lot of great culture, food, good weather, a little hot and humid, but it's a beautiful place. It's a place people want to live. So Tampa, we'll touch on Tampa a little bit. A lot of supply challenges. Every submarket's different. Largo's a little less supply constrained than other markets, but at the same time, things are flowing in. And so, it's been very important for us to just focus on that resident experience and renewals. I will also say we have had some challenges in Tampa specifically with ICE enforcement. In fact, over 70% of our delinquent residents were a direct result of ICE enforcement. Now, that was months ago. We've seen that kind of curtail, and we haven't had many issues going forward, but it's something we're definitely watching. So what does all this mean for Class B investors right now? Well, I can tell you at Ferris Capital Partners, we're slowing down our acquisitions a little bit and just watching the market. Whenever you see delinquencies increasing, you see concessions rising, it's time to just pause and focus on the projects that are already in hand. So that focus on expense reduction, bringing in new team members that can help get more work done in-house versus going out to third-party vendors, rebidding insurance, all those things have been underway and will continue to be underway. So we're staying focused on our current assets before bringing on any new. But at the end of the day, that's really what it boils down to. It's all about expense discipline. That is the difference maker right now. So all the REITs in their conversations talked about it, right? The ones that outperformed, they did it on the expense side, not the revenue side. So, better insurance terms, lower turnover on renewals, and managing your property taxes is what it's all about, and reducing those recurring expenses and those third-party vendor usage. is critical. So, bottom line is these are some reports you should be looking for. We'll be touching on these on a quarterly basis as these come out and doing a similar podcast at the end of Q3 and at the end of Q4. But the bottom line is the Sunbelt recovery is real. It is a bit uneven by market, but it's all being driven by demand, not hope. So that's what it's all about. Hope is not a strategy, right? And so when you have record inbound migration, absorption outpacing deliveries, renewal retention, is high. That's what it's all about. So I hope this episode gave you a little bit of a clearer picture on what's going on right now, particularly with these larger REITs. If you like this content, please like and subscribe and share with another high net worth individual that you think could benefit from it. And thank you so much for tuning in to the Multifamily Investor Playbook. Keep dreaming and investing big.